First, let me express deep appreciation of the fact that all of you are here. We greatly appreciate that. We greatly appreciate the fact that you kept the faith. I must also say that I'm very delighted that you've asked me to spend some time with you this morning. I've been asked to speak a little bit about the economy, the banking sector, and about the expectations of the regulator from professional firms. Now, the Honorable Prime Minister has set out the vision for the country. My job is to kind of look at the plumbing a little bit to see how best we can support that vision. Let me start with talking about the macroeconomic fundamentals. Now, those of you who are from Sri Lanka would say, now this man has been bleating on about the fundamentals being sound for a long time. It's not just me who has been saying this. I think on 4 occasions over the last 9 months or so, the fact that our fundamentals are in reasonable shape has been independently validated. The first such occasion was in March, just 3 months after our constitutional crisis during the 4th quarter of 2018. Also after all 3 rating agencies, in our view, unjustifiably downgraded us in December by being too hasty and taking letting the political uncertainty overdrive the process and not waiting for the Supreme Court to complete its deliberations. We thought they were very hasty. But despite the downgrading, despite the constitutional crisis, in March of this year, the government of Sri Lanka issued an international sovereign bond of $2.4 billion. And in March, the government not only raised that money, but the issuance was 3 times oversubscribed. The price was quite high, but we had access to the market, despite all the other issues that I talked about, because the underlying fundamentals were sound. Then in May of this year, the International Monetary Fund's Executive Board endorsed and approved the 5th review of the extended fund facility we had with them. So another independent validation. Then in June, just 2 months after the heinous April events, the government of Sri Lanka went to the market again and raised $2 billion. And this time it was 2.5 times oversubscribed. So despite the political crisis, despite the April events, the government of Sri Lanka was able to raise $4.4 billion in March and June of this year. Again, just last Friday, the Executive Board of the International Monetary Fund approved the 6th review of the extended fund facility. So these are all independent validations of the fact that the macro fundamentals are reasonably sound. So let me give you a quick snapshot of those macro fundamentals. If you take inflation as the indicator of domestic stability, it's currently a little over. So if you take inflation as the indicator of domestic economic stability, we have an inflation target of 4 to 6%. And for much of this year, the rate of inflation has been hovering around the lower bound of that target. It's now gone up to about 5.4%, and we think in the last quarter it might actually get closer to the upper bound. But then we see it coming down back to the middle of the target for next year. So inflation is very much within the central bank's target, and inflation expectations are pretty well anchored, and the outlook also is stable. Then if you look at the current account deficit of the balance of payments and the reserves as an indicator of external stability, the current account deficit has declined from, at least it's projected to decline, from 3.2% of GDP last year to 2.6% this year. So we're going in the right direction. And as for reserves, they are currently $7.7 billion, which is about 4.5 months of import cover, which for us is pretty adequate. And it also covers about 65% of our short-term external liabilities. So this is a reserve position which is comfortable. It's not great. We don't have the kind of insurance that some of the countries to the east of us have in terms of their reserve portfolio, but it's, by our historical standards, it's comfortable. Not only have we increased the volume of reserves, but we have been able to improve the quality of our reserves as well. Say in 2013, we had reserves, similar level of reserves, 7.5 billion, but 2.5 billion of that was short-term swaps of 3 months duration. So 2.5 of 7.5, 33, a third of it was short-term swaps. Then in 2014, at the end of 2014, we had $8 billion worth of reserves, and 2 billion, 25% were short-term swaps. Today, with reserves of 7.7 billion, our short-term swaps amount to 420 billion, so less than 5%. So the quality of the reserves have improved, the tenor has also improved, and I think we've also we've de-risked our reserve portfolio by the fact that short-term, volatile FII, foreign institutional investment, into our rupee securities market, which was as high as $3.7 billion or 14% in 2013, is now down to 620 million. We've imposed a limit of 5%. There is some room, because 5% is 1.4 billion. The current figure is 620 million. So we have about $700-800 million worth of space, but we have de-risked the reserve portfolio. In today's world, when the risk-on and risk-off phases for emerging markets can change on a tweet, I think it's important from our perspective that we have been able to de-risk our reserve portfolio by reducing foreign institutional investment in rupee securities from this peak of 3.7 billion to now about 620 million. So volume and quality of reserves have improved. So this is really, just a little thumbnail sketch of why we feel that our macroeconomic fundamentals are in reasonable shape. Having said that, the macroeconomic fundamentals are in good shape, but growth is muted. The economy is growing at about 3%, we think, this year. Of course, it was affected by the April events. The central bank had projected growth of 3.5% for this year, but now we think it will be 3% or a little less. The IMF and the World Bank say 2.7%. But clearly, growth is below. Our calculation of the potential growth rate is 5%. So that is a challenge. We need to get growth up, because in a sense, saying that the fundamentals are good when growth is 3% is like saying that a car, the engine of a car, is not overheating when you're driving at 30 miles per hour. We need to drive the car at 60 miles per hour, have 6% growth, and still have sound macroeconomic fundamentals. So that's the challenge ahead of us, and that's the vision that the Prime Minister presented really is designed to do that. And as the Honorable Prime Minister said, it's really exports. We have a challenge on that front. In the year 2000, exports of goods amounted to 33% of GDP. It came down to 11 or 12% by 2015. And the tradable goods sector, again, if you're a small country, and if your tradable goods sector comes down from over 60% to 38%, clearly you're not doing things right. And that is what happened to us as well. Because for a period of time, we had inward-looking statist policies where the priority was given to the non-tradable goods sector. But when you're a population of 20 million, you can't drive growth through focusing on the non-tradable sector for very long. So this is what we have to do. We have to change, and as the Prime Minister said, exports are the major part of the story. And we had significant biases in our policy framework against exports. Because for long periods of time, we had an overvalued exchange rate. And on top of that, we had an increase in our para-tariffs. Now, in today's world of cross-border production sharing networks, if you have para-tariffs, you're in serious trouble. Because you need to be able to, the distinction between imports and exports gets blurred. You bring material in, you do your little bit, and you send it out. If you stick a para-tariff in the middle of that, you become uncompetitive, which is what we did. So we have a very minimal presence in the supply chains of Asia. I mean, that has been the most dynamic component of the international trading system. That is, intra-firm trade in Asia has been the most dynamic component of the international trading system for the last 10, 20 years, and we have been excluded. But now we are maintaining a flexible and competitive exchange rate, and the government is gradually removing para-tariffs without impacting too much on revenue. So we are going in the right direction in creating the right climate. One other thing I should say, and this is what the Prime Minister mentioned as well, the budget has been the main source of instability in our system, the government budget. What is encouraging is with the new Inland Revenue Bill, with reforms to the VAT Act, improvements in tax administration, we've had a primary surplus in 2017 and 18, and hopefully there will be one this year, despite the impact on revenue and expenditure of the April events. We still think we can have a small primary surplus. Now, this is very significant because since 1953, there has been only one other year where the government has had a primary surplus. So 2017, 2018, and hopefully 2019 will be 3 years where the government has a primary surplus, but there was only one other year when there has been a primary surplus since 1953. So this is, I think we are beginning to see a structural improvement in the government's fiscal operations. And now we have to see, there have been lots of promises being made on the election platforms. I'm hopeful that these are not serious, because if they are, we're in serious trouble. But I think at least what is there in the government's books should get us a primary surplus this year. So that again is another significant improvement. So in terms of getting the growth rate up, the Prime Minister spoke to us. Really, I think there are key things. We need to improve the business climate. We actually need to also do some reforms in factor markets. Land, labor, capital. There are reforms which have been initiated. We need to consolidate and build on those. We need to, as the Honorable Prime Minister said, improve the business climate. We need to focus our investment promotion. We need to work on trade facilitation, and we need to follow through with the trade policy, with these trade agreements that the Prime Minister spoke about. On all these things, a start has been made. But now that the Prime Minister has gone, I can say that it's too slow. We have to do it faster. That has been the problem. The right things are being done, but too slowly. So that is the challenge in the next round. But not to change course, because actually Sri Lanka has a very narrow track in terms of policy. Because we've now graduated to upper middle income country status. We have challenging debt dynamics, which we can manage. I'll say more about that later. But we have to, in my view, have an arrangement with the IMF. When this arrangement finishes, we may not need to borrow from them, but we need to have some engagement with the IMF. We have to make sure that the ratings stay up, and we have to have access to capital markets. Because we need about $3 billion a year of borrowing to be able to meet our external obligations and to have a level of exports which will give us 4-5% growth. So that then imposes a discipline in terms of our policy framework. If we go outside, as I said, ratings, IMF, access to capital markets. Those are three important priorities for the country over the next 3 to 5 years. And that means you have, your policies have to be within a narrow track. So whoever comes into power, they can go 10 degrees this way, they can go 10 degrees the other way, but the broad framework, I think, has been laid out. And that is something very important that I hope will be absorbed by whoever comes into power next. So that's essentially the story in terms of the economy. As I said, fundamentals are good. We need to do the structural reforms now to get growth up. The other thing is the banking sector. And here my colleagues from the Bank Supervision Department have given me some very useful material which I'll share with you. The banking sector accounts for about 62% of the total assets of the financial system of Sri Lanka as at the end of 2018. At present, the banking sector comprises 32 licensed banks, 26 with licensed commercial banks, and 6 licensed specialized banks. There are 6 large banks with assets over 500 billion rupees, and 4 banks are in the top 1,000 banks listed by the Banker magazine. The assets of the banking sector is around 12 trillion rupees, and the sector provides employment for nearly 56,000 persons. The regulatory and supervisory framework pertaining to licensed banks is being strengthened with policy measures implemented by the central bank in line with international standards and best practices. So what are some of the regulatory developments? We are in the process of drafting a new Banking Act. The Banking Act was last amended in 2006, and the CBSL has initiated drafting a new Banking Act with a view to further strengthening the supervision and regulations of licensed banks. The key areas that are being factored into the proposed new Act include an overall mandate for supervision and regulation, strengthening corporate governance, consolidated supervision, resolution, imposing monetary penalties and fines. At the moment, the Director of Bank Supervision, the statutory authority, can't impose fines, which he finds very constraining. Ring fencing to mitigate contagion risk, strengthening provisions for mergers, acquisitions, and consolidation, subsidiarization for large foreign banks, and a differentiated regulatory framework for banks. Now we have a uniform regulatory framework for the largest and the smaller banks, and that is a constraint for some of our smaller banks, so we're trying to see whether it would be wise to have a differentiated regulatory framework. On the capital, regulations on the capital of licensed banks, the Basel III requirements were implemented in 2016 on a staggered basis, and banks were required to comply with a higher capital adequacy ratio by the 1st of January 2019. Currently, all banks are in compliance with these capital adequacy requirements. Now, and as a measure to support the implementation and to catalyze implementation of Basel III and to catalyze consolidation, licensed banks are required to enhance minimum capital requirements commencing 31 December 2020. Licensed banks that fail to meet this requirement will have restrictions imposed upon them in terms of asset growth, branch expansion, dividend payments, repatriation of profits, and they will be required to take any other measures that will prevent further deterioration of capital of such banks. I should say something about consolidation. We have 26 banks, 13 of them are foreign, and of course we may want more foreign banks to come in when the International Financial Center opens, but we have 13 domestic banks. Now I think Australia, which has a similar population to us, much larger area, much more complex and large, a much larger economy, I think has 4 banks, if I'm not mistaken. Singapore, with a much more complex economy and much higher level of economic activity, again has 4 banks. So we have 13 domestic banks. Now the challenge there is that we have a lot of bricks and mortar. Our OPEX is very high. With the technological change that is now inevitably going to overtake the financial services sector, we need to see how we can consolidate this sector, make it stronger and much leaner to be able to essentially address the balance that will have to be struck between technological advance and, obviously, the safety and security of the financial system. That is the challenge for the regulator, not to inhibit technological advance, but at the same time to make sure that the evolution of the financial services sector does not compromise the safety and security of the sector. On SLFRS 9, the central bank issued guidelines to licensed banks on the adoption of SLFRS 9 in December 2018. The adoption of SLFRS 9 will have a significant impact on banks' capital, and banks were given a period of 4 years to stagger the impact on the capital adequacy ratio. Banks are reliant on models. Hence, the CBSL has given a clear signal that proper governance and controls need to be maintained, and any anomalies would need to be addressed promptly. Now, on the domestically systemically important banks. At present, Sri Lanka has 4 DSIBs. They are really the banks with assets above rupees 500 billion, which is roughly around $2.8 billion US. And they've had a capital surcharge of 1.5 billion imposed on them, commencing at the beginning of this year, on the computation of capital adequacy. Considering the importance and impact of DSIBs to the banking sector and the economy, CBSL intends to formulate a comprehensive framework for determination of DSIBs in accordance with the principle-based framework issued by the Basel Committee on Banking Supervision. Corporate governance. CBSL wishes to strengthen corporate governance practices with respect to directors, CEOs, and KMPs of licensed banks. The necessary amendments to the Banking Act directions on corporate governance will be introduced, and some of the new measures will include a cooling off period, which we don't have at the moment. On market conduct and practices of treasury operations of licensed banks, with a view to further strengthening the market conduct and practices of treasury operations, the CBSL has issued a Banking Act direction to ensure that the treasury operations of licensed banks are carried out prudently and in line with international best practice. The directions will strengthen the market conduct and practices of the entire treasury operations of licensed banks, including FX trading activities. Other key regulations include various prudential regulations such as the liquidity coverage ratio, the net stable funding ratio, and leverage ratio under Basel III standards. And the central bank is in the process of reviewing other key regulations. Examination methodology of banks will continue to be enhanced through risk-based supervision focusing on efficiency, effectiveness, and sustainability of individual banks and the banking sector as a whole. On innovation and risk management, to allow for more innovation and to manage risks from new initiatives, risk executives are being encouraged to engage and be influential over the entire innovation cycle, and also to constantly review and moderate the risk appetite of their institutions. Banks must formulate forward-looking risk measurement systems and sound practices for managing risk, particularly in times of rapid growth in new products or markets as we are seeing today. The present dynamic market environment requires innovative products and business models that can sustain market leadership. Therefore, currently risk management in the banks is not only focusing on conventional risks such as credit, market, and liquidity risks, but also new risks such as reputational risks, cyber, and systemic risks. The recent high-profile global cyber attacks on financial institutions have highlighted the need to strengthen cybersecurity, and CBSL has already issued a roadmap to banks to improve technology resilience in the banking sector. Clearly, KPMG is geared up to help their clients to do this. Further, having identified the necessity to improve the technology adoption and technology risk resilience in the banking sector, we have issued a consultation paper for the proposed Banking Act directions on technology risk resilience for licensed banks, and at present, that is in the process of being finalized. Now, changing customer behavior and financial stability. In line with the developments in the information technology and financial markets, customer needs have also changed. Instead of face-to-face interaction, today's financial consumers value remote and efficient on-demand services. They expect instant credit decisioning, immediate account funding, and around-the-clock customer assistance. Financial institutions have realized that it is vital to respond to consumers' growing expectations and become part of their overall digital lifestyle. In response, most banks have moved to agency banking to cater to their needs. The CBSL issued Banking Act directions in 2018 on the appointment of agents by licensed banks with a view to introduce a regulatory framework to oversee agent banking businesses of licensed banks. And we see this is a challenge for the regulator to allow technology to drive the innovation which people are requiring in terms of convenience and speed, but also for inclusion. You know, there are lots of technologies that are becoming available for onboarding, which reduces the transaction cost of onboarding and clearly would be a major advance in trying to bring those sectors of the society which are outside the banking system now into the system. But there are KYC and AML CFT requirements. We were pleased to get off the grey list, the FATF grey list a few weeks ago. So we're conscious that we need to be very, very vigilant on that front. So the challenge is to get this technology in, to facilitate technology-driven onboarding, but also then to meet the AML CFT KYC requirements. Now, What do we expect from deliverers of professional services? In 2014, the Basel Committee on Banking Supervision has issued a publication on external audits of banks based on the Basel Core Principle 27. Now, there are a whole lot of expectations and recommendations in that Basel Committee on Banking Supervision core principle. I'm not going to go through all of those, but they clearly set out what the regulator would normally expect from audit firms. We're also reviewing the list of qualified auditors for the auditing of licensed bank. The Banking Act requires licensed banks to appoint a qualified auditor to audit the banks from a list of qualified auditors approved by it. The existing list of qualified auditors was approved by the Monetary Board in 1998, and it consists of 10 audit firms. In order to review the existing list of qualified auditors, EOIs from audit firms were called in 2018. The applications were reviewed based on the Monetary Board approval evaluation criteria, such as qualification of partners, strength and qualifications of the staff, experience and expertise of the firm, and availability of technical competencies. Accordingly, now 5 audit firms have been selected to be included in the revised list of auditors. So it's gone down from 10 to 5. The new list of qualified auditors, which will be applicable from financial year 2021, will be announced shortly. In this regard, as the regulator, we expect the audit firms to pay close attention to deploying an adequate number of staff with necessary technical competencies to audit licensed banks. And these teams should be commensurate with the size of the bank and its risk profile. It is very important that audit staff who are competent with information technology and developments in banking regulations are allocated to these audit terms. Going forward, we intend to permit the internal audit function of licensed banks to also be conducted by any audit firm, subject to the assessment of the capacity and competencies by the Bank Audit Committee and the approval of the Board of Directors of the bank. So we're saying even internal audit can now be conducted by an audit firm, an external auditor. We expect that an independent internal audit function will provide an assurance to the Board of Directors and the senior management on the effectiveness of the risk management of banks through a risk-based approach. But these internal audits will not be restricted to the 5 companies. It will be restricted to a much broader group. Also, I think there are expectations regarding the role of valuers. We've had some difficulties in the sense that clearly they play a very important role. At present, CBSL is in the process of amending the regulatory framework on valuation of immovable property of licensed banks, including the eligibility criteria of valuers to be in the panel of valuers for licensed banks. Credit rating agencies. Here again, in terms of the Banking Act directions on capital requirements under Basel III, banks have to use ratings consistently for both risk weighting and risk management purposes. So it is clearly very important that the rating agencies discharge their role in a professional and credible manner. So that's it. If I may sum up by saying, the macro fundamentals are in reasonable shape. We have started on the journey to strengthen the growth framework of the economy, but that needs to be accelerated. And the potential in terms of the outlook, this country has some great advantages stemming purely from its location. For millennia, Sri Lanka was a trading hub in the middle of the Indian Ocean. We need to rediscover our roots. Over the colonial period, that role was disturbed, and in the independent, post-independence era also, there have been phases of inward-looking policies, which have constrained us from realizing our potential of being a hub in the middle of the Indian Ocean, which is the vision that the Honorable Prime Minister has. So there, in terms of location, so we are 20 miles from India, 20 miles in particular from the 5 fast-growing states of southern India, rapidly growing middle class. Of course, we've always had this proximity to India, but the infrastructure in both countries was so bad that the added transaction costs which did not make it very viable for us to take advantage of this proximity. Now, infrastructure in both countries is improving. The Indian economy is expected to be the fastest growing large economy going forward. The manufacturing in India strategy may well throw up opportunities for countries in the neighborhood. And India's neighborhood first policy also plays into that. If you recall, when Japan grew and then China, all the countries in East and Southeast Asia were able to plug into those supply chains. So hopefully, if the Manufacture in India strategy gains traction, there will be opportunities for countries like Sri Lanka. And with the improvement in infrastructure, then there is now a much higher premium attached to proximity to India. In addition, we are smack bang in the middle of China's maritime Silk Route. That should create opportunities for us. The Prime Minister spoke about the Hambantota port and the large industrial zone we are hoping to develop around it with Chinese investment. And we also had years of excellent relationship with Japan, and there's a renewed interest for Japan to invest in Sri Lanka. We are in the process of issuing a samurai bond. Hopefully, it will be completed by the second week of December, about $500 million US. JBIC is giving us a very generous guarantee of 95% of the principal, and Japan is getting involved in a number of projects. And again, access to the Middle East, access to ASEAN, to East Asia. And I think going forward, particularly when the International Financial Center gets established, our time zone is a great advantage. We are equidistant from Europe and for the Far East. So if you get up at 5:30 in the morning in Colombo, you are pretty much ready for market opening in East Asia. If you stay on till about 9:30, you can work till pretty much the closing of markets in Europe. So this time zone advantage in an era where it doesn't really matter where you're located to work, given the technological improvements, I think our location in terms of reach to Europe and to the Far East at reasonably convenient hours, I think would be a great advantage. So we need to leverage our location. We need to maintain stability, strengthen the growth framework, and we have excellent international relations with all the major countries. There has been a renewed interest in Sri Lanka because of the geopolitics of the Indian Ocean region. So all the major countries are interested. We need to be friends of all, not to tilt in one direction or the other too much, and as the Americans say, we need to box clever to take advantage of this situation. So the outlook for the country, the prospects are actually extraordinarily promising. But we need to do a lot of things and do them right to be able to realize that potential. Thank you very much.